In this video, I'm going to share the top mistakes I see people making when using their credit cards. And since these mistakes could cost you hundreds or even thousands of dollars, I'll also explain how to avoid making them. Let's dive in. Mistake number 1 is ignoring the terms and conditions. Now, I get it. Reading the fine print isn't the most thrilling way to spend your time, but it's so important. Think of it this way. The terms and conditions hold the rules of the game, and ignoring them is like playing a board game without knowing the rules. You're bound to make mistakes. I mean, imagine trying to play Catan without understanding the instructions. Good luck with that. The T's and C's outline important information, including things like interest rates, fees, credit limits, payment due dates, the terms of any rewards programs, balance transfers, and also the issuer's rights to make any amendments to the terms. Skipping over this info could lead you to making the other costly mistakes we'll talk about in this video. Take the time to read the terms and conditions, and if you don't understand something, call your credit card company because they should be willing to help you out. If the jargon's confusing, look it up online because there are tons of resources breaking down credit card lingo. In fact, I've made a whole video on it and I'll link that right over here. You could even try asking ChatGPT to decode it for you. It actually does a pretty good job. Whatever you do, make sure you know the rules. Mistake number 2 is only making the minimum payment on your credit card. What do I mean by this? Each month, you'll receive a bill showing what you owe, and you're given the option to pay the balance off in full or pay the specified monthly minimum by the due date. The monthly minimum is just a fraction of your overall balance, typically just 1 to 3% of your total credit card bill. And while we'd all love to believe that banks and credit card companies are selfless beings, I'm sorry to tell you, but this is a trap. When you only make the minimum payment, you'll be carrying a balance. In other words, since you didn't pay off your entire balance in full, you'll be carrying your leftover balance into the next month. And what happens when you carry a balance? The credit card company will charge you interest on it. Credit cards are notorious for charging high interest rates, up to 15, 20, even 30% a year in interest. Each day your balance remains outstanding past the due date, you'll accrue interest on your balance, and this can quickly snowball out of control. Let's walk through an example. Assume your starting balance is $5,000. If your APR is 30%, in the first month, you'll be charged $125 in interest. Even if you make the monthly minimum payment of $50, your ending balance would be higher than what you started with. If you do this month over month, your balance will increase at a faster and faster rate. And by the end of month 12, your balance would grow to over $6,000. It's a slippery slope you want to avoid. The good news is, paying interest on credit cards is completely avoidable. Don't spend more than what you can comfortably afford to pay back each month, and pay your balance off in full and on time every month. Mistake number 3 is maxing out credit limits. So you apply for a credit card, you're approved, and are given a credit limit of, say, $1,000. Logically, you'd think that you're safe to spend up to $1,000, right? Well, not quite. This is a classic blunder with serious consequences. First, you could end up in credit card debt. Banks will usually offer you a higher credit limit than you actually need because they know it's going to make you feel baller and more likely to spend. And if you end up spending more than you can afford to pay back, you'll end up carrying a balance and could quickly find yourself stuck in a cycle of debt. Next, even if you end up paying your entire balance off by the due date and avoid paying any interest, your credit score may still take a hit. Why? One of the factors that goes into calculating your credit score is your credit utilization, and it accounts for 30% of your score. Credit utilization basically represents the percentage of the credit limit that you've used. So for example, if your credit card had a limit of $1,000 and you had used $500 of it, your credit card utilization ratio would be 50%. Credit agencies look at the credit utilization of all of your cards combined, and each card individually. Your credit utilization ratio signals to credit agencies how effectively you're managing your credit and how reliant you are on borrowed funds. It's recommended to keep your credit utilization ratio below 30% and for excellent credit scores below 10% but higher than 0% so they know you're actually using the card. Most credit card companies report your credit utilization ratio to the credit bureaus based on your balance as at the statement closing date, which is the date your billing period ends. Credit card companies typically give you 21 days from your statement closing date to make your credit card payment. So even if you pay your balance off in full by the due date, if your credit utilization ratio is over 30% on your statement closing date, your credit score could still take a hit. I've got a whole video that breaks down the credit card billing cycle, which I'll link right over here for you. But in short, the way to win the game is to keep your credit utilization below 30%, preferably single digits if you can, throughout the month, especially before the statement closing date. Make multiple credit card payments during the month to make this happen if you have to, and then make sure you pay your entire balance off by the due date to avoid interest charges and debt accumulation. Mistake number 4 is canceling your credit cards. And I'm going to put an asterisk on this one, and I'll explain why in just a minute. If you have credit cards you don't use, you may think it's a logical step to cancel them, a bit like canceling a subscription you no longer need. The issue is, by closing your credit cards, your credit score could take a hit in 2 ways. Closing your credit cards will mean that the credit limit available to you will suddenly decrease. If you have outstanding balances on your other cards, this could result in your credit utilization ratio increasing and negatively impact your credit score. Remember, your credit utilization accounts for 30% of your overall score. Second is by potentially reducing your credit history. Shutting down a long-standing account may significantly shorten your credit history and consequently lower your credit score. This is less of a concern since many credit scoring models, including FICO, keep its history on your credit reports for many years after you've closed them. So closing a credit card won't have an immediate impact on your credit score, but rather several years down the line. The length of your credit history makes up for 15% of your credit score. Before you close your credit card, carefully consider your reasoning. For example, if you've been struggling with overspending or don't want the temptation, a potential hit to your credit score could be worth it. And the same would be true if the credit card has an annual fee and you're not getting enough value from the account to make up for it. But if, on the other hand, the card is your oldest card, you have a thin credit file, or the only reason you're canceling it is you don't use it very often, there might be a smarter move. Think about keeping the card active by using it for a small monthly expense like a subscription, and then set up auto pay to ensure you never miss a payment. It's not enough just to keep your cards open. To avoid banks closing inactive cards without warning, a move that could harm your credit score as we discussed earlier, make sure you use them periodically. It's a simple strategy that safeguards your credit score and helps you keep your financial options open. Mistake number 5 is making late payments. It may not seem like a big deal, but trust me, being late on payments can mess up your financial game by bringing on a wave of problems. First, late payments typically lead to banks charging you late fees, which can range between $15 and $35. For smaller balances, let's say under a few $100s, these charges can constitute a significant percentage of your overall balance. In fact, a single late payment could cost you more than a full year's worth of interest on that balance. Second, some credit card companies may jack up your interest rate from your usual APR to a significantly higher penalty rate. And bear in mind that this elevated rate can remain in effect indefinitely, meaning your late payments may have long-term consequences. Thirdly, your late payments could hurt your credit score. 35% of your credit score is based on your payment history. Late payments on your credit history will reduce your credit score. Again, the good news is avoiding this mistake is easy. Automation is your friend here. Most banks and credit card companies offer automatic payment options, so use that to your advantage to make sure your payment hits on time every time. I see this video getting a little long, and I still have so much more to share on this topic, so I'm going to do a part 2. If you're finding this series helpful, please give me a like and subscribe to support this channel. And hit the bell icon so you get notified when part 2 is live. And once it is, I'll also link it right over here. And that's a wrap. Thank you and see you in the next video. Bye for now.